Hi, I'm Jimmy. In this video, we're going to look at how we can make comparing companies much simpler by using something known as common size analysis. Common size analysis can be a great way to compare companies to each other, no matter how big or small those companies actually are. We can also look at how a company has changed over time and to help us identify the company's strategy. So common size analysis is basically how we can look at a company's income statement or their balance sheet. I've also seen it done for cash flow statements, but the income statement and the balance sheet are really the most popular ways to use. First, we're going to touch on how to set the whole thing up and then how to make it all useful. Okay, so let's jump right in. And just so we have a real life example, we're going to apply our common size analysis to Amazon. So these are some of the main line items from Amazon's 2020 income statement. It's not all of them, but we can apply it for any line items. I just shrug it down to make it a bit more readable for us. So basically, we go up and down the income statement, taking each line item, divide by total revenue, and then that gives us a percentage attributable to that line item. So if we take cost of goods sold, $233 billion, divided by revenue of $386 billion, and that gives us about 60%. So now we know that Amazon's cost of goods sold, might also hear this called cost of sales, is about 60% of total revenue. Okay, simple enough. Now we do this very same math going right down the income statement, applying each of the line items to total revenue. Now just to keep this simple, I'm actually going to get rid of the two decimal places and just round everything to the nearest percentage point. So this is where we're ultimately trying to get to when it comes to a common size analysis, at least for the income statement. And the number one thing to remember when we're trying to set up is that we are comparing each line item to total revenue. Once we have that, it's all quite simple as far as how to set it all up. But now the question is, how can we use it? So the first thing we can do is we can compare Amazon's current 2020 numbers to their own historical numbers. So this is Amazon's numbers going back the past 5 years. And we might notice a few things when we look at this type of analysis. First, look at something like cost of goods sold. Amazon actually calls theirs cost of sales, but cost of goods sold is usually the way it goes. Well, we can see that those numbers are gradually falling. And just so we're all on the same page, cost of sales for Amazon is the purchase price of all the goods that they ultimately sell, plus any inbound or outbound shipping costs, and a few other things, but that basically summarizes it. So the fact that this expense is heading lower is a good sign for Amazon. Now, we may notice that in 2019 going into 2020, well, we actually saw a 1% increase in the cost of sales. And Amazon actually addressed this, they came out and said that this was due to increased expenses that happened during COVID. So it's very possible that we continue to see cost of sales head lower, which is a good sign for Amazon investors. So now we could easily go down, right down, line item by line item, analyzing the trend for the company. And then when we get down to net income, which is the same thing as profit, well, we can see that profit is in fact heading higher as a percentage of revenue, which again is a good sign for investors. Okay, so that's simple enough. Now, another way we can use common size analysis is when we compare one company to another company. So what if we were to compare Amazon to Walmart? Now, I'm only going to use the past couple of years so I don't have to make the font too small. We could fit everything on the screen. But again, looking at some of the key line items between these two companies. First, we can see that Walmart pays more for their cost of goods sold, which means that right now Amazon has a slight edge since that is an expense. And because Amazon has a lower cost of goods, well, they end up with a higher gross profit margin. Now, I also think it's interesting that Walmart doesn't have any research and development expenses, and Amazon does. Although knowing the difference just top of our head between the two businesses, I'm not too surprised, but it is interesting to note. And if we knew nothing else but that, well, this would tell us something about their overall strategy. Now, if we're doing a deeper dive on either one of these companies, this could be worth digging into. Why does this happen? What is ultimately causing one company to have no research and development, and while another company has fairly significant research and development? Now, in this case, Walmart was showing 0, but even if Walmart was showing a pretty high number, but pretend that number was only 3% of revenue, well, we can notice that with common size analysis. That's one of the advantages of common size, that you would pick up on that where you might not pick up on the discrepancy between the two companies without looking at a percentage. If you were looking at just the hard numbers, they might look more comparable. Then moving further down the income statement, Well, income expense looks quite low for both companies. This implies at least manageable debt. And then tax expenses. These are right here. Now, I should point out that this 1% for both companies, well, that is not their tax rate. Their tax rate is based as a percentage of pre-tax income, not revenue. I think in 2020, Amazon paid like $2.8 billion in taxes. So we don't want to look at that and be like, oh my God, look at how low their tax rates are. This is a percentage of revenue. You don't pay tax. Companies don't pay taxes on their entire revenue. They paid on profit. So ultimately, we need to remember that common size analysis is versus revenue. And then we look at the profits of each company. Well, here we can see that in 2020, Amazon had triple the profits of Walmart on a percentage basis, which again adds a lot of color to our analysis and can give us some real insight as to the differences between the two companies without going any further, which again adds some color to our analysis. And I think that this is the real advantage of using common size analysis. It could be used to look at a company's strategy and how effectively they're pulling off that strategy. And it makes comparing companies of different sizes much easier. I mean, just look at the revenue for both of these companies. Walmart is a much larger company on a revenue basis. But we saw that with common size analysis, well, it appears that Amazon is operating much more efficiently than Walmart is. And ultimately, it's common size analysis that provides much more usable numbers. And this is actually why they call it common size. In theory, you can compare companies of no matter what their size is, how do they stack up to each other? Where are they allocating the most revenue? Now, if we didn't use a percentage, just to illustrate, if we don't use common size analysis, well, just to illustrate real quick, this is what some of their numbers would have looked like. And clearly, this is much tougher to interpret. We can see that Amazon has better gross profit in 2020, but to me, this is not nearly as clean as if we were to look at it from a common size perspective. And one other thing, we may have noticed that it says here, fiscal year 2020 for Amazon and 2021 from Walmart. Well, that is because Amazon's year end, their fiscal year ends on December 31st of each year. Walmart's fiscal year ends on January 31st of each year. Now, that's worth noting because these two companies aren't comparing the exact same time period. Now, overall, I think the analysis still works just fine. It is a simple month apart, but we do want to keep that in mind. If one company ended 6 months later, you might have to go quarter by quarter. But either way, I just wanted to bring that up. That's why that looks different if you happen to notice that. So it's very possible that we use common size analysis. Let's say we compare 3, 4, 5 companies from a single industry. Which one seems to tell the best story? Which one seems to be more interesting? Once we do that, we research that particular company, and then we try to come up with a fair value for that company to see if it's worth buying at this point. Now, I actually recently did a video where I go through 4 of my favorite ways to value stocks from the communication services sector. And those valuation methods can be used in many different companies in many different sectors. I'm just going sector by sector in that series. So if you're curious, well, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.